Well, good morning, ladies and gentlemen, and thank you very much indeed for joining us on the third grueling day of Davos, or is it the fourth or the fifth? I'm sure we've all the days slightly run into each other, particularly if you don't get that much sleep. But I'm happy that you've been able to join us, and I hope that you're still fresh from your breakfast, coffee and tea. When I first agreed to moderate this panel, it was called Should We Fear Slowdowns? But when I arrived this morning, I was surprised and disappointed to see the single word unequivocally put up there outside the session room door, and it said recession. So clearly we have decided between the conception of this panel and our all arriving here this morning that this is a recession, although those of you who've been watching my colleague Richard Quest on CNN in the mornings will know that he's actually had a narrow majority of corporate leaders and other guests on his show who have signed up to the S word as opposed to the R word. Anyway, there's no good crying over spilt milk. If WEF, the World Economic Forum, in all its wisdom acquired over more than 30 years, declares that this is a recession, then who are we to quibble? And certainly not I. Now, steady, reliable, sustainable growth is the natural order of things, at least to the corporate eye, and certainly to the hawk-like eye of the financial analyst out there in the markets, whom corporate leaders pay a lot of attention to. But the real world, excuse me for those of you who are corporate leaders, excuse me, but the real world is different, certainly in terms of the macroeconomy. Slowdowns are regular occurrences. Depressions, thankfully, only occasional ones. Depressions perhaps once in a generation or in a lifetime, let's hope so anyway. And recessions, only really occasional ones. There's no real definition, by the way, of a depression, so it's rather easy to slip from one to the other, and perhaps that's an issue that we might return to in the course of the next hour or so. They're all, however, a matter of falling activity, falling private investment, and above all, failing confidence. So, should we fear slowdowns? That is the title of this session. And are they necessarily a bad thing in terms of keeping economies healthy? In other words, is it a good idea to let the economy slow down, brace oneself for losses, corporate failures, but view the whole process as a kind of welcome shakeout? A chance to weed out some of the weaker competitors while the stronger ones can regroup and resources are freed up so that those stronger ones can better use them, take up the challenges when the upswing comes, as economic history tells us that it inevitably has. Well, that's if you like, almost a kind of Darwinian, neoclassical viewpoint. At the other end of the spectrum is the viewpoint that perhaps policymakers should do everything that they can to iron out the economic cycle and preferably get rid of the business cycle. You may remember what Marx said about the cycle, that it showed many of the contradictions of capitalism, and socialist economies tried with decidedly mixed success to iron out the business cycle. Now, in the course of the session, we may well get into what we mean by slowdown versus recession, although that's relatively obvious, and we'll wonder perhaps whether an extended economic contraction is genuinely more harmful to the ultimate health of the system than a brief pause to mark time. And I think one of the things that we would certainly want to ask ourselves is, what should policymakers be doing? Should they be working together to maintain as much stability as possible while accepting that there will be upswings and downswings? I don't want to become too theoretical here. I think we all have a host of practical examples, a host of concrete ideas, and I want to get you as an audience engaged in this as quickly as possible. Well, we have a well-balanced panel. Before I get into introducing them individually, I mean, if you look from your left to your right, you'll see a leading policymaker from one of the world's largest and indeed fastest growing economies. We have a corporate leader whose role it is to advise and support other companies. We have we have a distinguished Asian professor, and we have the president of a leading banking player, leading investment banking player. So really we have quite a good spread here. Let me introduce you individually. Palaniappan Chidambaram, you're the Minister of Finance of India. You have, you're a lawyer, but with an MBA from Harvard. You've represented a constituency in your homeland of Tamil Nadu for a generation or so. You've had a wide range of portfolios, and now you are the Minister of Finance. Tim Flynn, you hail from the United States. You've been getting on for 30 years with KPMG. And you are in the area of auditing, the auditing profession. You are advising the U.S. Treasury Secretary Hank Paulson, and this gives us an idea of how seriously your views are taken at the very highest levels, and certainly in this forum as well. Takatoshi Ito, you have a PhD from Harvard, so there's a common Harvard theme here among two of my panelists anyway. And you later taught there, among many other distinguished universities. The University of Tokyo is where you are at the moment as professor at the Graduate School of Economics and Public Policy. And Jerry Missier, you're originally Canadian, I believe, a chemical engineer, but for the last 20 years you've worked in investment banking, above all in the derivatives area. So let me start straight away by asking you, Minister Chidambaram, do you see any value in slowdowns?
If a slowdown is a pointer to the end of one business cycle and the beginning of another, I think we should take that in stride. But if a slowdown is a precursor to a recession, I think that's worrying. It's especially worrying for developing countries like India. A slowdown will affect our exports. A slowdown could also affect capital inflows into India and other developing countries. We need more exports, we need more capital to grow our economy. So how can I, as a minister, welcome a slowdown? I may have to tolerate a slowdown for a few years, but I can't welcome a slowdown.
Tim Flynn.
Well, I think from a business perspective, a slowdown moving through business cycles can be healthy. It is a way for companies to take a look at their business model and make change to the business model. It realigns capital. It'll have companies look at their risk architecture, their governance, and coming out of that, they can become more efficient, more effective, and get repositioned for coming out of the slowdown in the next growth cycle. So I think it can have positive attributes. I'm not an advocate of saying we should have a slowdown, but I think it can have positive attributes coming out of a slowdown as companies reassess where they are.
I'm not sure you could take that position. I mean, you have to welcome it or not, it seems to me. I mean, if you say that it can have positive aspects, does it have more positive than negative aspects?
I think it depends. I mean, if you look at history, I said we've come out of slowdown. It depends how deep it is, how prolonged it is. If it's a transition from one cycle to the other that moves through pretty quickly and allows people to come out, companies to come out of that and become healthier, I think it can be healthy at that point in time. But clearly, if it's leading toward a recession and goes deeper, then it's not. So how you manage that from a standpoint of monetary policy, economic policy, and coming out is very critical to the process. Thank you.
Professor, what do you think?
Well, let me start with the, since I'm professor, start with the academic taxonomy. Slowdown is a lower growth rate but positive. Recession is a negative growth rate for 2 quarters in a row. And depression is breakdown of payment system, banking system, and so on, and sharp, like GDP goes down by 1/3 or something in the 1930s. So those are clear sort of taxonomy in the literature. And I think in our profession that we managed to build the macroeconomic literature that yes, we can iron out some of the ups and downs by policy, but don't overdo it, because try to do it by, we call fine-tuning, always becomes the problematic, because there is a lag from policy implementation to the effect on the economy. So they use built-in we call built-in stabilizer, which is a natural force to help the in the downturn by spending more and so on. Credit cycle, which we have now, that overextension of the credit and asset price rise, and that has a natural consequence of the downturn, which I think you cannot fight to stop it too much. You cannot go through the cycle to clean out the bad debt and so on. Only policy can do is try not to make it to depression that you support.
So you rely on what Ronald Reagan called the magic of the markets and what George Soros calls market fundamentalism.
No,
rather than non-policy makers.
No, I'm not a fundamentalist. I think there is a role for the policy to safeguard, but you cannot really, make it absolutely smooth in a fixed rate of the growth. So ups and downs are natural, and you have to go through the cycle once you overbuild the housing, for example, like in U.S.
Jerry Missier.
Well, there's still a certain inevitability to the business cycle. We've seen with globalization, the benefits of globalization, the benefits of more efficient markets, of having efficient markets for the transfer of risk, that we've managed to have longer up cycles and shallower down cycles. To the extent that we have periods of slowdown, slower economic growth, it can be very useful to preventing the buildup of excesses, which ultimately lead to more significant recession and downturn. So to the extent that we have those periods of correction while still having growth, I think they can be useful.
Okay, let's return, I think, perhaps to you, Minister. What do you feel policymakers should be doing? Do you accept what Professor Ito was saying there?
I do. I think policymakers can't sit back and wait for market forces to smoothen out the slowdown. We have to take proactive measures. It depends on which country, which economy, what context you are in. India is growing at 8.5%. A slowdown to, say, 8% or so may not require very active policy intervention. But where it affects our exports, we would have to go to the aid of exporters. Where it causes disruption in capital flows, we would have to take some policy measures to attract capital. If a slowdown is accompanied by continued high commodity prices, that's a double whammy. So one would have to take steps to moderate inflation. So I think policymakers would have to intervene depending upon the context in which you are and the country in which you are.
You make an interesting point there, which is, of course, when we have a slowdown or a recession, there is usually a cause. And although we'll perhaps have to leave it to economic historians to decide exactly what is at play at the moment in the world economy, certainly high commodity prices are part of that whole picture. Tim Flynn, are you relatively relaxed about the measures that policymakers take to obviate the worst effects of slowdown, or do you feel that policymakers sometimes wrench the tiller around, wrench the steering wheel around perhaps too violently from time to time, or maybe they just fail to get ahead of the curve?
Well, I think it's a complex world today with the global economy, what's happening around the world. So I think people are finding their way in this new world with freer capital flows and what's happening, the emerging markets. There's a lot more interdependency. So when I look at it in the U.S., the consumer is 70% of the GDP. And I think the policymakers have to look at, at what point in time do we really lose consumer confidence, and at what point in time is the consumer stepping back, and how that might play against the economy. From the investor standpoint, if people overinvest, excess, and that has to work through the markets. But how do you have that right level of confidence, and when do you come in to build that confidence to make sure you don't go from a slowdown down to a recession? And I think that's really the balance between growth, trying to maintain that growth, at the same time trying to let the markets work. I think that's a challenge. I think it's even more challenging today with the global economies and all the things that are happening.
Professor, I think, again, Tim touched on something rather important, which is that in the US context, the consumer is very large. 70% of the economy. This is not the case with, in particular, with a number of developing economies. And sometimes one can have a slowdown in one area of the economy, but not in another. Is it possible to completely isolate, let's say, an investment slowdown from a slowdown in retail spending?
Well, the investment is known to be more volatile than consumption. And as Chinese economy now and Indian economy now has large portion of the GDP in investment. So, it is natural that they go through the cycle, slowdown and higher growth, although the trend is much higher than the developed countries. Well, Japan went through that. Japan in the 50s and 60s, we had 10% growth, but sometimes, growth recession down to 5%. It was a real pain to have 5% growth, but now you don't have that kind of growth anymore, rather stable at 2% growth. So as Minister mentions, that it depends on the history, depends on the country, and so on. When you are riding bicycle very fast, it's rather bumpy. But
Jerry, let's come back to our original title, Should We Fear Slowdowns? I mean, looking, if you like, from the microcosmic point of view of investment banking, and particularly the derivatives area in which you've been active for most of your career, do you fear slowdowns, or are these other opportunities to, if you like, to make trading profits, but also perhaps to play a role which is overlooked, perhaps generally in the economy?
Well, as I was saying, I think slowdowns, without sort of tipping into recession, can be useful for preventing the buildup of excesses. I think the financial markets, and specifically the markets for the hedging of risks, have a big role to play in creating a period of and a backdrop of economic stability. I think one of the great benefits that we've seen of the last 20 years has been that the creation of very liquid hedging markets across all the different asset classes, I think, has been a one of the reasons that we've had longer up cycles and shallower downturns.
Well, that's going to beg an obvious question from me, which is, can you get us out of this mess? But actually, this is a mess that started in the financial sector.
Well, I think one of the key issues that historically you see as you enter into periods of slowdown is that when the banking system remains active and is able to intermediate, to provide credit, then you can typically avoid a significant downturn. Recessions typically have been characterized, in the deeper ones, by the significant contraction of credit. I think one of the most significant things that we've seen in the last 3 months has been this sort of simultaneous write-down of asset values and recapitalization of the banking system. Historically, and if you think back to the early 90s, even think back to 5-6 years ago, the banking system has run into trouble because of a slowdown or excessive risk concentrations or exposure to things like the property sector back in the early 90s, and was completely frozen. I mean, there was no, the recapitalization took time. There was an unwillingness for investors to put equity capital into the banking system. And famously, the difficulties that the UK banks had in the early 90s and with failed rights issues and things like that. And I think today we're going into this period with a much more robust banking system, notwithstanding the fact that we've seen all these write-downs.
Well, let's come to the fascinating example. This brings us neatly to the example of Japan and the banking crisis in Japan, doesn't it? Because what we saw as a result of the bursting of the Japanese bubble of the 80s and early 90s, we saw a banking system which was in crisis, which was deeply in need of reform. And to be honest, we've seen a very long period of slow growth in Japan ever since, despite the fact that the banking sector is now in much better shape.
Yeah, I see a lot of parallels between the Japanese banking crisis in the 1980s and U.S. Subprime crisis now. Japanese banks hit the most of the losses in the subsidiaries which were off balance sheet, which is the case in the U.S. And blanket guarantee was needed in Japan to prevent the further erosion in the banking system, which is the case in the UK. Credit rating was always behind the curve, which was a case there and now. But I think Japan, in case of Japan, the disclosure was so slow and regulators were not forcing it. Evergreening was permitted. So it took 5 years to really recognize and work out the crisis and the resolution.
The disclosure could take a long, long time in the case of the subprime crisis. You know, famously, as we've all been saying, you know, we don't know where the bodies are buried, despite the fact we've known that there's a bubble and a problem for many months now, and some would say for the better part of 2 years.
Well, but still faster, I think, than Japan. In Japan, from recognition, it's the first sign to the public money injection into the banking capital. It took 5 years, 6 years. Now in the U.S., it's 5 months. It's a public money injection, although it's not public of the U.S., but public of the Middle East.
Okay, I'm going to. Well, indeed. Well, that's another issue, but I think that's one that's come up many times here. Can I throw this open to the audience? Is anyone bursting to come in here with a question or a comment? Do feel that it's your session as well, please. Gentleman over there. Do we have the microphone is approaching?
Good morning. Felipe Larraín from Chile. Mr. Missier was mentioning that the cycles, the downturn of the cycle, and particularly in the post-Second World War period, was much, benign, much more benign than previously, and that is in fact correct. And as Professor Ito has studied, the recessions, typically last a couple of quarters. If you take the U.S., for example, and look at all post-45 recessions, which there are only 3 of them, they've taken 2 to 3 quarters. And the question here for the panel, if not what you want to happen, because it's obvious that you want it to be as short as possible, but what you believe will happen with the current recession. Are we in for this typical pattern of post-World War II, 2 to 3 quarter recessions with GDP drops which are 1 to 1.5% from peak to trough, or are we in for a longer and protracted recession? There's some people here at Davos that believe that we're in for a longer, 4-quarter recession, and that will break the pattern of post-World War II, recessions.
Yes, I think we're talking here very much about the U.S. economy, aren't we?
Mainly the U.S. Yeah, mainly the U.S. economy, but the U.S. economy and the world cycle, are sort of correlated.
Yes, I think one of the things I think I'd like to add to your question, if I may, is this. We often worry, we talk about the recession as being the point at which the economy is heading downwards, and we've been talking about Japan. What we forget is it may take an awful long time up this way for the economy to get back up to the same growth path, to its trend growth pattern, and that is also likely to be an extended period of pain, slow gathering of confidence, slow amassing of investment. Let's go to you, Minister Chidambaram. In terms of the U.S. economy as an outside observer, what's your hunch? Are we looking at something long and vicious, or are we perhaps looking at a relatively brief and relatively benign slowdown or short, shallow recession?
Well, if you believe Mr. Greenspan's report in the papers today, there's no conclusive evidence of a recession. If the U.S. economy grows, say, by 1 to 1.5% a year, that's not a recession. That's a slowdown, and the U.S. economy can bounce back. What gives me confidence that the U.S. economy will bounce back is it's a very innovative society. It's very inventive. It's knowledge-based. It can quickly recover with appropriate policy stimuli. It can recover. And this is just a hunch. In fact, you asked me, what's my hunch? My hunch is it'll probably slow down for about 2 to 3 quarters, but it should bounce back.
So that's a recession, actually, if it's 2 to 3 quarters.
Not if it's growing at 1.5%.
Slowdown, okay, all right. So you're not actually, no
bounces.
negative growth. Okay, fine.
I don't think the US will go into a negative growth.
Tim?
Well, I think from a couple of perspectives, as I talk to the CEOs of our clients in the U.S., their core business is pretty strong. And so the underlying core business, they feel pretty good about. The global economy, the weaker dollar, the exports has helped fuel some growth and has allowed us to expand. So from that standpoint, they feel pretty good. But there's this uncertainty, this little uncomfortness regarding where is the consumer going to be, how deep might the housing really be, how long might it take before we come out of the housing process. And so I think the balance of those two things is the strong global economy, the weaker dollar, the core business is being good outside the financial sector, and then looking out where's the consumer going to be. And with the rate cut and hopefully the stimulus package to keep the consumer some confidence in the market and move the consumer through, then I think I would agree that maybe it's a slowdown with very slow growth. But depending upon, again, the housing recovery, how long that might take, how big of impact it is, access to capital for consumers and debt, I think the question is still out. Then I think from that standpoint, in the financial institutions, the real question is when will liquidity come back in? When will they be loaning again? And how tight will liquidity remain? As Jeremy said, and that access to capital is a critical component of coming out and regrowing and re-energizing the growth side.
Do you think that the role of the sovereign wealth funds will be, if you like, to offset, by bringing back liquidity and by bailing out, if you like, taking long-term strategic positions in banks which have run into trouble, as various sovereign wealth funds have done? That is clearly positive, isn't it?
From my standpoint, and Professor Ida talked about, the recapitalization and getting a new capital into the banks in a very quick way to work through has been a very positive event. And again, as we look forward in the changing world that we're all in today, and there's a lot of discussion about sovereign wealth funds as past investors and what they've done, it's a very important part of the economy right now. It's coming at a very important time, and I think it's been welcome.
Okay, Jojo Missier, what do you feel on all of this?
I'm actually optimistic. I share the views of the other panelists. I think the U.S. economy is very resilient. It's very open. It has the potential to bounce back very quickly. We've had a lot of stimulus. The currency, now monetary policy, fiscal policy, and reiterate the point about the banking system having been recapitalized. So I think this will actually be a period where the U.S. economy avoids actually negative growth.
Let's try to be a devil's advocate.
Please.
I think there is a fundamental problems with the U.S. Housing market and also credit market. Housing market, there is an overbuilt inventory of housing. The demand is about 1.5 million homes, but it has been in the pace, production was in the pace of 2 million for a couple of years. So there is inventory which they have to work out, and it will probably take a year or two. So housing will be depressed for the next year or two. Credit market, although it was recapitalized, the banks are not in the mood to extend the capital, extend the credit to the credit card consumers or the corporations in the housing market and so on. So the banks are okay, but they will not be aggressive in extending credit. While the U.S. consumers are known to be, on the credit culture that they borrow and consume, which doesn't work anymore. So probably consumption will be lower. Well, the last line of defense is this tax rebate. And I'm not sure whether this tax rebate would work. It would work if there is a lot of consumers who are credit constrained. But millionaires, getting $600 or whatever will not, it doesn't make any difference in the consumption.
Well, yes, on the other hand, a millionaire's $100
Oh, 100, I'm so sorry.
and a pauper's $100
Okay.
when spent have the same effect. Well, depending on where they're spent, but if they both each buy the same commodity, be
No,
that, let's
millionaires
say,
will not change any consumption plan. They just substitute whatever, their consumption, what they would have used. This is known as whether a temporary tax cut would work or not. This is a literature thing. It only works when there's a credit constrained consumers.
okay.
Minister is shaking his head.
All right, Minister, go ahead.
I don't agree with that at all,
Please.
I'm afraid. I think that's a very pessimistic view. All right, if asset prices decline, what does it mean? I bought an asset at a higher price. Now my asset is of a lower value. I have to pay a mortgage. I am a little poorer, and the mortgage payments extend over a period of time. But that doesn't affect the fact that I hold a job, I have an income. Unless there are job cuts and retrenchment and layoffs, that kind of thing is not happening. I still have an income, and it'll take a little more time to pay. Maybe the government will step in and freeze interest rates as they plan to do. There is a tax cut. I think all this stimuli will work. And as far as banks not lending, what will banks do if they don't lend? I thought the dharma of banks is to lend. So they will lend. Credit may moderate a bit. They will continue to lend. And remember what I said a little while earlier. The US is a very resilient, innovative, inventive, knowledge-based economy. And that will give the spur to growth. I don't take a pessimistic view as Professor Ito does. I think with appropriate policy stimuli, people holding their jobs, not losing their jobs, with tax rebates, $800 per capita for 300 million people is a huge sum of money. I think the US can bounce back after 2 or 3 quarters of even say very slow growth. I think it's possible to bounce back.
All right, well, do you want to take this further?
No.
You'll rest your case?
Yeah.
Okay, thank you very much for now. Another question perhaps from the audience. Gentleman here in the red sweater.
Federico Rampini from La Repubblica, Italy. This is a question that can be addressed both to the policy maker, Mr. Chidambaram, and the professor of economy, Professor Ito. The impact of a recession on social inequalities. You just mentioned the possible different impact of the fiscal stimulus, but let's speak of the recession itself. We have seen that in the United States there are households that are under the threat of foreclosures. Millions of households might even lose their jobs. At the same time, we have seen chief executives of large American banks being laid off, but getting away with huge bonus packages. So could a recession even accentuate the social inequalities that were already growing during the growth period? And what should policymakers do to address this different impact on different categories of people?
I think it's an excellent question, but I'd like to extend it to all our panelists, if I may. I know you can find it too, but certainly, Professor, I mean, this is an excellent point, isn't it, that you were making yourself a moment ago, in effect, that people at the bottom of the income scale are going to suffer far more in a slowdown than those with very well padded bank accounts up at the top of the scale.
I think the recession always hurt the poorer most, and that's always true. So I think the safeguards should be applied to those who are not earning much in terms of the economic policy making. But remember that a couple of years ago we were complaining that globalization and high growth promotes inequality. So complaints are always there that high growth or slow down. But truth is, I think the growth will promote everyone to benefit, and it's only the first stage of the growth that it may the inequality may appear widen. But we true inequality pain comes when the slowdown happens.
Well, certainly in the case of growth, what we're concerned about is that the benefits should be shared out so that growth does not have the effect of heightening inequality, as you say.
Right.
But equally, when we talk about a recession, what we need to be doing is thinking of ways that, again, we can share out the pain so that the poorest do not suffer the most as they do at the moment. And would you agree that possibly the best way to do that is through the fiscal system?
It is there that whenever the unemployed happens that they receive the unemployment benefits, and if income falls down a certain level, then you get the state assistance. Those safeguards are there among most of all of OECD countries, and I think developing countries have some challenge in that safeguard system, but the fiscal system does have those what we call a built-in stabilizer.
Okay, Professor Ito, thank you. Mr. Chidambaram, you were the other intended victim of that question. No, intended target of that question, so go ahead.
Well, it's certainly likely that a slowdown will hurt the poor more than the well-to-do. And therefore, policy stimuli would have to be carefully calibrated that it helps the poor more than it helps the well-to-do. For example, you said that there's a danger of mortgages being foreclosed. I think legislative intervention is possible to stop such foreclosures. State assistance is possible to spread the mortgage out over a longer period. And if tax breaks are given, if I was asked to design a tax break system, I would design it in such a manner that tax breaks are given more to people with lower incomes than to people with high incomes. These are all amenable to carefully calibrated policy stimuli. And one must design it carefully so that the pain is eased for the very poor. Those who are very rich can afford to suffer some pain.
You're a politician. Surely, in political terms, a slowdown is one of the most difficult situations that you can get into. I mean, let's leave aside some of the other issues that we talked about, whether the rest of the economy can deal with it. But if you were to see any significant reduction in growth from the, 8.9% that you're seeing in India at the moment, politically you would be in trouble, wouldn't you? You would have a good reason to fear a slowdown.
No, I would not be politically in trouble if my growth rate slows down from 8.9 to 8.
I didn't say that. What I'm saying is if you're talking about down to 5 even,
yes,
or if it went closer to the flat line,
then jobs,
you would be in serious trouble.
Of course. I would be in even greater trouble if my inflation rises to 6 or 7%. Therefore, one has to balance growth and inflation. At the moment, we are comfortable with inflation below 4% and growth above 8%. But in the US context, if you are in the second term of a two-term presidency, why should you not take risks?
If you're the president, but if you're seeking re-election to Congress, then you would be very worried.
Of course. Therefore, every congressman and every senator must support a policy package that is designed to help the poor more than it helps the rich, designed to ease the pain of the poor than the rich. And in that sense, I think he should get political support.
Okay, but let's just, can we just agree, I'm sorry to press you, but let's just agree on this, that from a political point of view, a slowdown is difficult. It would be a challenge. I mean, I'm not saying that this is going to happen in India, and I'm sure you're right when you say that growth might, edge back down to 8, towards 8%, possibly 7.5%. But I mean, it is that from a politician's point of view, this is the big nightmare, isn't it? Because of expectations above all.
It is. It is. Therefore, we have to do everything to keep growth high and inflation low. Please remember that the other side of the coin is just as important in a developing country. Inflation must be kept low. Between inflation and growth, what hurts the poor most is inflation. Therefore, I must keep inflation low and then aim for a reasonably high rate of growth. But if I aim for a high rate of growth and high inflation, I'm sunk.
Thank you. Jerry, what do you think of this? And listening to this discussion of the social impact of a slowdown, I mean, it seems a long way from the derivatives market.
True. Look, I think the best tonic for social policy is a strong, growing economy that's creating lots of jobs. The way you have, and in a sustainable way. I do think, and to tie back to derivatives again, having efficient markets, having a mechanism in place for companies, for institutions to apply capital, to access financing, low-cost financing, to hedge their risks, goes a long way to preventing the buildup of excesses that ultimately manifest themselves in not just slowdowns, but in recessions. And to the minister's point, when you have growth that is accompanied by high inflation, then you have the very difficult choice of either allowing the inflation to run out of control, which is very, very bad for everyone in the economy, in particular the lower classes, or fighting the inflation by adopting a very rigorous monetary policy, where then you risk having a significant recession that's accompanied by lots of job losses.
It's a difficult message, because if I can reinterpret it this way, I mean, if I'm a guy on slightly below average wages and I've just lost my job and I'm trudging along the street and a derivatives trader just zooms by in the Porsche that he's bought on his bonus, I should be saying to myself, thank goodness those derivative traders are out there, because they're going to save us from the worst effects of the slowdown. Well, I'm sorry to be a bit populist here, but it is a difficult message, isn't it?
Well, no, I think the message is not one of the trader in the city versus the person in the streets, or this is one of the role that efficient functioning and liquid markets can play in creating sustainable economic growth. And I think it's the best measure that we can implement. The absolute best way to ensure that we have long-term sustainable economic growth is to have free-flowing capital markets and liquid hedging markets, and an underlying financial system that is there to provide the backdrop to stable growth.
Tim Flynn, do you want to come in on this issue of sharing out the social pain?
Well, I think it's been talked about. I mean, clearly, there's no question that in the less fortunate from an economic standpoint will feel creating jobs, creating opportunity, allowing people to reach their full potential is a critically important component of what we're trying to accomplish.
Okay. What do you think of the answers, gentlemen from the Repubblica?
Yes, well, maybe if there was a representative of trade unions here, we would have a different perspective. I'm just
Do we have one?
I'm just a reporter.
Is there somebody from a trade union organization or confederation who's here? Never mind.
But anyway, I'm just a reporter.
No, we've got a hand up there. No, not on that point. Okay, no. All right. Okay, well, we'll come to you in a moment. Go ahead.
So I can just comment on what Mr. Missier said, that somehow it looks like the generosity displayed by the Federal Reserve in its recent rate cut will save both the derivative business and the people who are in his business, and will probably avoid harsh consequences on the middle class and under average incomes, because they will this aggressive monetary policy could reduce the social impact of the crisis. But I'm not sure that those who are responsible for the worst excesses in the finance sector in the United States will learn the lesson if the monetary policy is too accommodative.
Comeback on the comeback?
Yeah, look, I think that, monetary policy is all about the economy. This is about preventing a financial markets event from turning into a real economy event. I don't think it has anything to do with with saving Wall Street. I mean, losses have been taken, and and a lot of those aren't coming back. I mean, asset values have fallen, and whether interest rates are at 4% or 3% isn't going to affect the value of a lot of those assets. That's a fact. This is all about ensuring that the economic slowdown, or the potential economic slowdown, is as soft as possible. And I think it's a measure of how the global economy has changed, that policymakers need to now respond much more quickly. And I think we have to get used to the fact that cycles tend to be very compressed, and the traditional sort of time frames of analysis of waiting for data are a thing of the past. I think the current economy and going forward will be characterized by much more sort of almost volatility, if you will, of policy in response to what is now a very dynamic, a very open global economy.
Good morning. My name is Matthias Kietzmann from Focus News Magazine in Germany. I've got two questions. The first one is, I wonder why everybody on the podium is so confident that all the problems in the banking sector have already been ironed out. If I read the headlines this morning, there may be more negative surprises to come. So what makes you so sure that most of the problems after 5 months have been already ironed out? And the second question would be, even if US consumers will be more reluctant to spend, there's only 300 million of them, but there's now 2.5 billion people living in India and China. So I wonder, can these fast-growing economies carry the world economy through, or can they? What effect does their strong growth have relative to slower growth in the US? Thank you.
Okay, two very, very important questions there. Tim, can we really be so confident that the worst problems in the banking sector have already come to light, or do you think that there'll be more evil surprises like SocGen?
Well, I think, I'm not sure the panel today has said that they're all behind us. I think what we've said is that there's been a lot of correction already in the asset values and what's happened. Liquidity is an issue still going forward, and liquidity and access to markets. In what we have today, a lot of the write-down of assets is being driven by a liquidity issue where you can't refinance the assets with short-term paper and some long-term assets. So you're forced to take some sales and to raise capital. And that's a market-based accounting today. It's a market-based model for mark-to-market these assets. And the values are reflecting what the market is today. And I don't think we can sit here today and say we know exactly where that market's going to go. And you could still have deterioration in the ability and liquidity of these assets, which will drive down their value more. So can anybody say with confidence that the write-offs are behind us? No, because it's based upon where the market's going to go. And so these assets are being transparently marked to market, and as the market moves, you're going to mark these assets to their fair value. And so there's going to be volatility in a fair value accounting model.
We've been talking about the banking sector before, but again, in summary, answer to this. Go on.
I think Mr. Flynn's description is pointing a fundamental problem in the bank regulation and this what's known to be Basel II procyclicality. That once the downturn in credit market happens, then there is some mechanism to force that things worse because of the mark to market, and you have to make the capital adequacy so that you have to sell quickly, and that depresses market and so on. And we don't have the answer to that. To ensure the transparency and accountability, that you have to you have to have this mark-to-market system. Otherwise, you get back to the Japanese long stagnation. So, but that will force this procyclicality. And we are seeing that in probably in the typical worst case scenario. So probably we have to go through a little bit more downturn in those asset prices, but we have to find the bottom, so-called. You have to find the bottom. Then you have to grow back. So what I'm saying is that this credit cycle is a cycle that you have to go through. You cannot stop the washing machine in the middle of the cycle, right? You have to go through the till the end. Otherwise, it's very messy.
Very indeed, yes. I'm sure many of us have experienced that. Minister, let's come to the second part of the question from the gentleman from Focus magazine, which is we're looking at the 300 million consumers of the United States and forgetting about the 2.5 billion who are in your country and in China. To what extent do you think that you can provide the locomotive, or one of the locomotives, that will drag us out of all of this?
Not much. The U.S. consumers are estimated to consume a little over $9 trillion a year. And China and India together is about 1.75 trillion. These are numbers which Stephen Roach put out yesterday in a panel. Now, we can't make up for 9 trillion when we are at 1.75 trillion. But to the extent that the Chinese and Indian economies are growing, that their capacity to consume also grows, we can help. But I don't think we can make up for all the suspected or feared loss of consumption in the U.S.
Okay. Nods all along?
Yeah, would agree.
We'll go with that.
Can I ask,
please,
Mr. Chidambaram, that there is a debate about the decoupling. When the U.S. slows down, whether China and India and Asia will slow down because of the spillovers, or they are quite independent, and the intra-regional trade is so much stronger now that they can grow. Your economy's growth will not be affected by, say, U.S. growth goes down to 1%.
Well, I don't think we can decouple as such, to the extent that exports play an important part, but that's not as important as investment and domestic consumption. So as long as we can ensure that investment is buoyant and domestic consumption continues to rise steadily, we can moderate the impact of U.S. and worldwide slowdown. But I don't think we're going to be very greatly affected unless there is a catastrophe that envelops the whole world. A slowdown in the US or in the Western world or in the developed countries may moderate our growth a bit, but I think we will still continue to grow at a steady pace. The estimate for calendar 2008 or fiscal 2008-9 is 8.5%.
I would just add one thing. I think clearly India and China are very important economies to what's happening in globalization, but I think you can look beyond that too. 20 years ago, there were 27 countries that had GDP growth of 4% or more. In 2006, there were 120 countries with growth of 4% or more. So you have the rise of China and India, but there's a rise of the rest of the world as well. And so I think you have a more diverse economy globally that we're dealing with, and consumers in various parts of the world. So India and China are critically important, but there's a rise of the rest of the world as well over the last 20 years.
we take another question? Sorry, yes, excuse me. Yes, I remembered you, gentleman here in the front row.
All economies have the history of cycles, ups and downs. And there have been good reasons. They've been analyzed. And very often there are macro factors which drive that, or lack of information about capacity which is building up in consumption historically. This time around, I don't think that's the kind of problem. It's financial institutions building extreme opaqueness which has caused this imbalance. Or I was just reading today's comment of the CEO of SocGen saying the trader was mentally weak. So is this a different problem, and therefore will there be different solutions? Or are we trying to build kinds of solutions and macro solutions which we did in the past to deal with the problem which is not necessarily the kind of problem we had, where it was not limited intent, and very conscious limited intent not to make the transactions transparent because it was making more money? That's the question.
Okay.
Well, I would say that the situation we find ourselves today is not unique. We've had financial market events throughout history. 15 years ago, there was a crisis of excess property lending and excessive construction, and therefore too much supply that led to a contraction in the commercial and residential real estate markets in most of the developed economies, and that led to a recession. 25 years ago, it was the commodity, the price of oil collapsed and impacted third world debt. And you can go on and on all the way through history, whether it's the stock market crash. So this is not unique. The key is, does a financial market event become a sort of a real economy event? And what history tells you is that it has that potential when you end up with a net contraction of credit at a time when you also have other negative factors affecting the economy. So that's why I think most of us have been relatively optimistic about the outlook, because we don't see that sort of confluence of events that could have the impact of turning this into a more significant economic downturn.
Minister, do you want to come in on this?
Well, I suppose, I hope that that was not an attempt to whitewash what banks and financial institutions have done. Clearly, there was either lack of regulation or poor regulation. When I asked a leading policymaker in one of the leading economies of the world, why did the subprime mortgage crisis happen? And he said innovation was the reason. What does that mean? It means that regulation had fallen behind innovation. I'm not advocating over-regulation, but clearly, even in market-driven economies, you need well-designed regulations and very competent regulators. If the regulators had done their job, I think the subprime mortgage market crisis could have been largely avoided. So while the fact that a crisis has happened today may not be unique in human history, what is unique about this crisis is it's a clear case of failure of regulation or failure of regulators.
I agree that, and I would like to make a parallel in the history that in Asian currency crisis, 10 years ago about this time, we're talking about Asian crisis, how to stop the meltdown in Asia. And again, there was a clear lack of regulations, and the potential liability was not was looked over by regulators. And we have done a lot of things since then, and there is a less likelihood of similar emerging market crisis happen now. But again, as Minister Chidambaram mentioned, that this innovation, new securitized products regulation was behind, and this subsidiary known as conduits were looked over by the regulator, and it's a shame that this contingent liability was missed. And also originators and origination bank just sold those securitized products, and they just wash hands, and they don't take any risk. So there was an inherent moral hazard of making risky loans and securitized and sold off. And in the olden days, that those origination bank has to work out. They were the leading leader to make sure that whether foreclosure works or more rescheduling of mortgage would work, and they would have taken lead in workout. Now they sold off the securitized, and nobody's in charge of the workout. So that's why the president has to come in to make sure those workout would be possible.
Jared, do you want to come back again? Because I think this is fascinating.
Yeah, I disagree with the minister. This is not unique. I mean, you could say the same thing about every previous crisis, that regulation should have seen this. And I think it's also difficult to point to any one constituent here and say it was the regulator's fault, it was the bank's fault, it was the Fed's fault for having easy money too long. It was these things always have a role. The role of many different constituents go into creating these situations, and that is not unique to this particular.
But it's difficult. It's difficult, isn't it, even for the Fed and certainly for regulators to stay on top of what goes on with some of these highly complex financial instruments. I mean, I was talking to somebody who started in banking about 40-odd years ago in the mid-'60s, and he said, he worked for one of the big US investment banks, and as a trainee, you could go around every department and get a pretty good idea of what they all did. And that meant that if you were the CEO of a bank like that, you had a fair oversight of what was going on. And if something went badly wrong, you were capable of understanding what it was. CEOs of investment banks today do not understand what every department does, because frankly what they're doing is so complex and so very clever that actually it will be almost impossible. I mean, they know who to ask about what's going on or what's going wrong, but really the problem is complexity. What you're saying, and of course you would say this, is that all of this is beneficial, that it helps us all, and complex financial markets are actually more effective and more efficient, do their job better. But there is a case to answer there, isn't it, that if you get too complex too fast, the regulators simply won't be able to catch up with you. And in the end, that will be bad for everyone, as we've seen from the subprime crisis.
I would disagree with your comment, Charles, about the nature of banking. Yes, clearly it's more complex, but even in the last 20 years, if you think of the evolution of technology, of systems and the infrastructure to track, to cope with the increase both in complexity and volumes, the amount of oversight that takes place, it's evolved significantly, and yes, the history of financial markets is one of innovation, excess, crisis, and then from the crises you get sort of innovation that takes you out of it, and you begin the next phase of the cycle. And I don't think that will go away. I do think that regulation today is far more effective and more on top of things than it was 20, 30 years ago, and I do think there is much more coordination across the regulatory community globally, and the interaction between regulators and financial institutions is much, much more robust than it was.
Okay. Let's take another question. Well, we've got several more, actually. Gosh, we've got 5. The questions are mushrooming. Let's go for this gentleman here. Apparently we can only take one. Is that what I'm being told? Yes. Sorry about that.
I just had a comment on
Well, I'll tell you what, let's go for the burst. I think we've got about 5 questions. Can we have 5, 2 over here and 1 there? So if we could just have quick questions. Give us each a quick question and we'll answer them all together.
I want to come back to the decoupling. I think the emerging markets of the world, and there's a tremendous amount of growth across emerging markets. It's not only India and China, but the Middle East, South Africa, Russia, driven by commodity markets, much stronger balance sheets. And these much stronger balance sheets means the emerging markets don't have to have loans from London or Washington to continue their growth. And I think that's a big part of the decoupling. If you look at major American multinationals in their reports coming out of the 4th quarter, most of us are experiencing growth despite recessionary conditions in many markets in the U.S., even in 2007. And the reason for that is because of the participation in emerging markets all over the world.
Okay, thank you. I'll take that as a comment rather than a question, if I may, but thank you very much for it. Jeremy Warner, I think you had your hand up.
Yes, Jeremy Warner from The Independent. Historically, debt overhangs of the sort we see in the States and elsewhere have always culminated in a recession. So is there not a danger, my question to the panel, is there not a danger that the policy action being taken, lower interest rates, more liquidity, fiscal stimulus, is ultimately going to make the problem worse and not better?
Thank you. I will take this question over here, lady here.
Hi, I'm Bhagyashree from the Straits Times, Singapore. My question is, have all the bubbles burst in the various areas of the global economy, or should we be bracing for more bad news in 2008?
Okay, thank you. I think we have one more question. I took a question from you earlier, and since I'm afraid I have to ration things at this point, and I'm being nodded at by my producer here, let's start with you, Minister. Could you respond to the comment or the questions that we just heard?
No, to Jeremy's question, unless you outline an alternative approach, I think what is being done is right. Tax breaks, monetary policy measures, and maybe some fiscal measures. If you say that that's going to make the problem worse, what's the alternative? Unless you present an alternative, I mean, how does one judge the merits of this package? I think what's being done is, first, I'm told according to the textbook, and secondly, I think instinctively, I believe that's the right approach to impending recession or a threatened recession. So I really can't agree with you that it'll make the situation worse unless you tell me what alternative policy package you have in mind.
I would agree.
Okay, but what about this question here? Have all the bubbles burst? What about that one, Tim?
Well, I probably wouldn't be an accountant if I could figure all that out, but I'm not sure.
We have great faith in accountants to spot bubbles and to have the right weapons to prick them with.
The history would show that we're going to find more bubbles as we move through this process. Immediately tomorrow, I can't tell you where they're going to be, but the markets will correct, the markets will adjust, excesses will be shaken out of the markets, and I'm sure there's economies and spaces today in the world where there's still some excess going on, but in markets will work our way through that.
Professor, you would perhaps have a crack at both of them, actually. The question of the debt hang inevitably leading to recession because it has in the past, and have all the bubbles burst.
Yeah, well, recession thing that I think that I have some sympathy to the comments that, as I mentioned, that cycle has to go through, and probably we haven't seen the bottom yet, and it's rather difficult to stop the cycle. And all the policy should do is to make sure that that will not spill over to other markets which are fundamentally healthy. I do believe that U.S. housing market was a bubble, and it has burst, and you have to go through the cycle. Where are other bubbles? I'm not sure. I think the Spain, Ireland, those housing markets are overheated, people say. So
UK?
UK maybe too. So they may have some bursting or at least slowing down, taking cues from the U.S. market. I'm sure that may happen, but I'm not sure that is a burst of the bubble in those countries. But high housing price, rapid increase in housing prices in several countries, I think I do have some fears what's going to happen.
Jerry?
I would disagree also with Jeremy. I don't think you necessarily need to see a debt overhang leading to a recession. In fact, the early years of this decade, in the wake of the dot-com bubble bursting and Enron, WorldCom, et cetera, the capital markets completely seized up, and it was one of the most mild economic downturns that we'd seen in the post-war period. So this is why I'm optimistic about the present time. In terms of excesses and bubbles in 2008, it's difficult to point to any one thing, but to echo Tim's comments, financial markets will move to excess, and undoubtedly there will be periods of excessive asset valuation that will manifest themselves with bubble-like characteristics.
About decoupling, you mentioned that emerging market with commodity producers are enjoying the robust growth, but if the developed countries like U.S. and Europe and Japan slow down significantly, then there'll be less demand for those oil and commodities. I think there is a sign of already the oil prices coming down due to the slowing down, signs of slowdown in the U.S. So if there are enough slowdown in the developed world, I'm sure the commodity prices will go down, and that was the case in Asian crisis. So decoupling doesn't work in that case.
Okay. At this point, I think I'm going to just ask a question of you, the audience. You've been here for the past 70 minutes, listening to the discussions that we've been having. Are you more or less frightened of a slowdown than you were before you came into this panel this morning? So can we have hands in the air, please? Who's more frightened now as a result of what we've heard? All right? Less frightened of the slowdown. Well, I must say that this is, I really have to give credit to our panelists here, because although it seems to me that we've explored a huge number of areas here in terms of slowdowns, what they are, what their implications are, who suffers from them, what policymakers should be doing, whether we've got much more worries and bubbles out there, whether we should be inevitably, thinking about a recession. The panelists have poured oil on these troubled waters. Oil which may have cost them $90 a barrel, but it's been very effective. So thank you very much indeed, and thank you, the audience.